Hey, good morning, everyone. Marty Missouri here, Wednesday, the 12th of October, 2022, with a brief midweek market snapshot for you. It's been quite the week, quite the last week and a half for equities. Recall a week ago, last weekend, we were looking at some pretty bullish technical setups, really negative sentiment, got an amazing two-day pop Monday and Tuesday of last week. Since then, we've been rolling over quite noticeably. We've given back all of that two-day pop and meandering our way toward tomorrow's CPI number. And there doesn't look to be anything under the surface that suggests it's going to be something that pleases the stock market. Today's producer price index came in above expectations on a month-over-month basis. We were up like 1% in futures or close to it in equities until 5:30 a.m. Pacific time when that number came out, and stocks rolled over and they're slightly red as I speak at you here at the moment, but they are moving on every conceivable headline from whispers or comments from Fed governors to expectations that Friday, the Bank of England, as the governor stated, will no longer intervene into the government bond market that just about blew up their pension system here about a week ago. Interesting, the change in tone from central bankers globally. They, I think, are still reeling from their, to be frank, their egregious misinterpretation of what inflation was going to end up being post the whole COVID situation. There are, as we've expressed here, structural factors, long-term changes, evolutionary changes that are at the same time cyclical, if I may, from a purely long-term perspective, where we are entering into a new regime that is really defined by deglobalization, populism, etc. And those are structurally inflationary forces that in all likelihood will lend to higher on average inflation for many years to come versus what we've gotten used to. Beyond that, though, the combination of massive fiscal stimulus on top of massive monetary stimulus, you had the makings of some serious, real, lasting inflation, in a sense that the whole populist energy under the surface is going to equate to much higher wages, much better treatment of labor going forward, and that just got turbocharged with the whole COVID thing. And now you have a much higher cost structure among corporate America, but throughout pretty much the world, and therefore that gets passed on. And when you have still a relatively healthy consumer, certainly from an income and a balance sheet standpoint here in the US, not necessarily everywhere else, well, then you have the ability to pass through. Pepsi announced very good results and very good expectations going forward this morning. They're raising their prices, but people are paying it. So consumer staple stocks, which you'd expect in a weakening economy, have been holding up pretty well of late. So we have these dynamics. I kind of suggested just now that the rest of the world doesn't look so good. Europe is probably in recession. I think the UK, as of this morning, based on the data that came out this morning, is in recession as we speak. And ultimately, though, folks, when you look at what is coming from a fiscal perspective going forward, and again, the strong, populist energy that is, I think, here to stay, coming into recession, and as we work our way through that, particularly in Europe right now, you're going to see liquidity from the fiscal end brought to bear on the economy. And, we're actually looking at the seeds of the next bull market over there. And so I don't think we need to be resoundingly bearish on Europe, for example, and there's other parts of the world we can talk about. When we have, a 6 month to a year to a couple of year time horizon, it's going to be very interesting to see things play out. If indeed we are looking at a real global recession, right? And that's been our base case, certainly here in the US, although more of the mild variety. We'll see inflation come off the boil. Didn't show up in today's producer price index, may not show up in tomorrow's consumer price index, but I can show you charts, and I have, of lots of things rolling over in the commodity space and the transportation space, yada yada, that says, you're going to see inflation come off the boil more so as we get into next year. That's going to ease the pressure on central banks. They're going to ease off the pedal, and you're going to see the market and sentiment really ramp up. But it's ramping up within the context of structurally higher inflationary forces. So I think, folks, over the next few months and years, we're going to see this real volatility and this real push-pull that is centered around higher underlying inflation. Now, indeed, it's going to lead to some serious opportunities going forward in many places that have to do with where governments are going to be spending all this money, where in the world the best values lie, where in the world they're going to be producing the things that the government's going to be spending all this money on. So when we look out beyond the shaking out that's left to do with this bear market, and it makes sense to us that we go lower before things totally shake out, you got to be pretty bullish on the macro opportunities over the next few years. So that's where we sit right here today, and we'll continue to give you more texture on what those opportunities are as we go forward. But in the meantime, for today, this exercise is just to look at the short-term technicals and the longer-term technicals when we get to the weekly chart. So here's your hourly chart in front of you, and you notice I have painted here a lower low right now here as of yesterday on the hourly. Each candle is an hour, and real definite bullish divergence on the MACD, and still a positive divergence coming off of oversold levels on the relative strength index. And then if we do a real short term, you can see that is definitely a bullish divergence that very well, if not likely, will fail if we get a strong CPI report tomorrow. If we get a weak one, we'll probably get a real strong ramp higher. For a moment anyway, and it could last a few days or even a few weeks. Remember again that you get through the second week of October, right, seasonality speaking, to the rest of the year. Seldom do you not make money in that scenario, and from what I'm gathering from other people's word, seldom do you not make money coming off the bottom in a midterm election year going into the third year of the election cycle. It tends to be a very bullish phase. So I think market players are very cognizant of that seasonality, but we've got these huge central bank, CPI, inflation headwinds in the way that could make it turn out differently. But sentiment is really, really weak, as I keep pointing out. Whether it's just a short-term tradable bottom or something meaningful from a long-term perspective, they tend to form, and you tend to bounce off of really weak sentiment. And some people will argue that it's not that weak, but the fact that people are arguing that it has to get worse before it gets better is part and parcel to that very negative sentiment, which we see out there right now. So the hourly looks constructive, but I wouldn't hold my breath. The daily chart looks constructive as well when you look at these divergences, right? So your price is lower, your momentum oscillators are higher. However, this sure looks like a bear flag to me, right? And if this bear flag plays out, we are going to breach our 3,500 price target there too. So we'll see how that plays out. So mixed signals, the bear would jump all over this bear flag, and that looks like a bear flag to me. The bull, would probably go like this, and point a down sloping wedge with these bullish divergences. And, technical analysis patterns are in the eye of the beholder. No ifs, ands, or buts about it. I see the potential for a nice pop here, but I think we're going to have to get some kind of a surprise short term, when it comes to weak data. Bad news is good news right now for obvious reasons. Or we just kind of wash out and we just that seasonality takes over, and a few good earnings announcement like from Pepsi today, and kaboom, we're off to the races. Something constructive happens in Russia, Ukraine. China abandons their zero COVID policy, which contrary to what I've been suggesting here of late and things that I'm seeing that says they're about to, boy, their news reporting says no way, not anytime soon. They are, however, rapidly producing antiviral medications. So I think they're looking for kind of an inflection point where they can get, the antivirals. They're actually manufacturing Pfizer's one that apparently works pretty well. They're also working on another vaccine that's structured along the lines of the ones here in the US, yada, yada. When they think that they can treat people or vaccinate people effectively, then they abandon that zero COVID policy. But if they're waiting for that, it may not be until next year. But if anything in the meantime suggests over there that they're relaxing it, that could be very, very bullish for global stocks. Certainly would be bullish for Chinese stocks. They, at the same time, they are stimulating. Credit data for last month were quite impressive relative to the previous month and to what was expected. So clearly, they are trying to offer up stimulus to the economy while they're still locking it down in places. They're calling it dynamic zero COVID at this point. So we'll see how that plays out. Lots of moving parts in this market going into this fourth quarter of the year. And then lastly, we'll just take a peek at the weekly chart. So the weekly, by the way, has already hit the price target, the downside price target, and that's that moving average. When we started talking about it, it was about at 3,500, and that's kind of the line we drew as our, official price target, if you will. Remember, though, it was all predicated upon no recession at the time when we first started looking at the patterns. And now I would say yes, recession, but mild recession. So that 3,500 could still ultimately hold. Would not surprise me, not in the least, to see it come down lower than that, though, because again, we're seeing weaker economic conditions, and we're seeing some very interesting decisions being made on the part of global central banks right here. So they seem to be hell-bent on perhaps ultimately cracking something, if not breaking something. Then I think you'll see them turn tide and pivot like we've seen them so many times do in the past. And that would be, something like in the UK, something in the fixed income market that kind of blows out, and you find these big levered players under the surface who are exposed. The old Warren Buffett analogy, you never know who's swimming naked till the tide comes out, and I think there's naked swimmers out there. And as that tide goes out, and they bear themselves to the world, so to speak, you're going to see central banks have to do something about it. So maybe it'll take something like that. Maybe it's just an improvement in the inflation data along the way, and the market kind of bounces around in here. But our $3,500 price target, save for what might happen in the fourth quarter, we may not see that. We may bounce off of that with all this positive seasonality and negative sentiment. However, let's not be surprised if we don't ultimately breach that. But anyway, markets are dynamic, so we've got to be in our analysis as well. But in the weekly, you do have this, I think very clear bear flag pattern that played itself out. You could argue that, you've got another one there. We're not quite coming against the grain like you normally do. But in here, you do have, I think, a downward wedge. I'm kind of playing the bull here on the weekly with these positive divergences. So again, technicals look okay, if not constructive. Fundamentals and the macro environment look dangerous still right here. So folks, I'll leave it there. I said it would be quick, took longer as usual than I anticipated, but I hope it was helpful. Talk to you again very soon. Hope you have a great day. Bye-bye.